Hi, this is David Reyes. Thanks for joining me this week. We're going to do our weekly vlog here today, and I'm excited to talk about our new book, the Little Red Book on Retirement. And I'm going to do a series here going through each of the chapters. They're small. Really proud of the book. Just came out a couple months ago. Very readable, and I'm excited to share this with you. So, when my impetus to do what I do, part of writing this book, was that 1995 was my first year in the business, and green behind the years as an advisor. I was 27 years old, and unfortunately my grandfather passed away, which was very devastating. Unfortunately, he was diagnosed with dementia about 5 years earlier. He worked for Sears back in the 70s and 60s and 70s when that was a very successful company. He owned Sears stock. And had a good retirement. Again, he wasn't a wealthy man. He just was very conservative. His home was paid off, all those kind of good things, Social Security. So he had a really good life. Problem is that he private paid in his long-term care. I mean, he used his own money, and then he qualified for Medi-Cal. When you qualify for Medi-Cal, basically you're bankrupt. You can only have $2,000 in the bank, a burial plot, a wedding ring, a car, and a home. And so not good. Save your whole life to have nothing in the end. And so that really taught me a big lesson about how to manage money, how to protect against capital loss and devastation of capital. And so you need to have proper planning to deal with these things, holistic, integrated planning. Unfortunately, most of you don't know what that means, and most of you don't have this type of planning, which is really sad, is most advisors are not interested in this type of planning because it takes a lot of work. Most advisory firms, I'm not picking on them, it's just what they do. The big firms like Merrill and those types of firms basically are doing asset allocations. So they're taking your investments and doing this pie chart, pretty little pie chart, these different colors and really pretty. But the fact is, it just doesn't work. What you've learned about diversification of portfolios in retirement does not work. Let me give you an example. In 2008, the market was down at one point in time 55%. Bank stocks were down 80%. Devastation. The average balanced portfolio of stocks and bonds was down 30%. Let me ask you a question. Does that sound conservative to you? No. But you were sold, or you were told that this type of a balanced portfolio of stocks and bonds would be something that would be conservative and would be okay with you in retirement. Well, that's just too much of a loss. It's too much of a risk. So if you had $1 million in 2008, you lost $300,000. Now, our firm we're not going to have that kind of drawdown in our type of portfolios. But the problem is you need to worry about this stuff because most of you have you have an investment plan, which I'll disagree with most times, but we don't have a retirement income distribution plan. And that takes a lot more effort and skill and experience doing this for 22 years. And you have to really want to do it. It's a lot of work. But in order to have the proper retirement planning, you need to have this type of comprehensive integrated planning, such as a retirement income distribution plan. Okay? We want to make sure we stress test your assets to make sure that we're not taking undue risk. We want to have a fee analysis, make sure we're paying the least amount of fees. We want to have a written plan. And unfortunately, I have not run across one client that has all of these things that we need to have a stress-free retirement. So we like to call what people have diversification. So you're diversified, but the fact is that that's not enough. We can't afford to lose 30% in a down market. So one of the things we need to have is, secondly, we need to have diversification not just by asset class, but by actual different types of strategies like real estate. Because, for instance, we don't want to suffer losses like in 2008 we talked about. Again, a 60-40 portfolio of stocks and bonds was down 30%. So one of the things we want to do to help mitigate risk is we want to have assets like real estate, other assets, maybe even annuities, other things that are not correlated to the stock market. So when the stock market goes down 20, 30, 40, 50%, we have other assets that help to mitigate that loss and also to have their own returns. So for instance, real estate's a great asset class to give as an example that we use quite a bit as a hard asset, because when the market goes down, or is the income from that real estate going to go down 50%? No. Some of you have real estate properties. In '08, did your income drop by 50% in your real estate? No. So real estate, I'm giving you one example of many that we use to help mitigate risk. So we want to diversify within our stocks and bonds. That's good advice. We want to do that, but it's not enough. We want to also diversify by strategy, that other strategies that do not rely on the stock market for their returns. So, you know, what's an answer to all these things? First, we need absolute diversification. We need to be in investments like I talked about that have all these attributes that will give us a truly diversified portfolio. So the third thing we want to see is we want to have some risk management to the stock portfolio, the equity side, which most of you don't have either, because it does take some work. What do I mean by that? What I mean is diversification is not enough. So if the market's going to fall 30%, your portfolio in an 08 financial crisis, what can we do to help mitigate those losses above and beyond the additional diversification that we're doing? We use strategy to help insure the portfolio, not like we're buying an insurance policy, but help to mitigate the downside. We insure everything. We insure our homes, we insure our life, our health, all these things. But why do we not do insurance or use insurance, a form of insurance, a form of downside protection to protect against catastrophic risk? What we do for our clients. Let me give you an example. One would be one of our basic strategies, what's called a stop loss strategy. Let's say you have $1 million in one of our stock portfolios. We're going to put a predetermined amount of loss that's going to be a maximum of 10%. Now, if the market goes down 30 or 40, we're capped at 10. So that's one way to mitigate risk. The average person, the average one of you that I'm doing reviews for, your average loss is about 30%. Average, and you consider yourself a conservative investor, and you're really not investing conservatively, and you just don't know it. So those are the things that we do. This is the first set of a series I'm going to do. So the bottom line is I want to teach you how to mitigate risk, how to maximize return. We want our cake and eat it. So our goal is to mitigate risk, mitigate volatility, and they have the opportunity for more income and more returns. So join me next time. We're going to talk about, again, our next edition is going to be the next chapter here on the Little Red Book of Retirement. Thank you.